Hello and welcome to a special note in which we're going to be talking about a landmark for the UK stock market. The FTSE 100 has closed at a new all-time high for the first time since December the 31st, 1999. Now that sounds like a big deal, and I am here to argue that it isn't. First of all, we have to bear in mind that the FTSE 100 is a very strange index. If we take a look at it now compared to other FTSE measures of the market, you can see that it tells a very different story. The FTSE 100 is very much dominated by resources companies, oil companies and banks, many of which have most of their operations outside the UK. It doesn't tell you much about the UK economy. It also gets reshuffled very frequently. More than half of its members from 1999 are no longer in the index. Now, if you compare that to the FT30, an older index with only 30 companies in it, which doesn't get reshuffled so often, you can see that that would suggest that the UK is still very much mired in a bear market. Meanwhile, if you take a look at the all share, which is perhaps a better, broader representation of the UK market, you can see that it had managed to make highs back before the crisis in 07, and that it's been at highs for a while. It tells you a very different story from the FTSE 100. Now, if we go on to take a look at the FTSE in international context, again, that suggests that there isn't any reason for British people to be that excited about this latest development. Over the 15 years since the FTSE was last at a high, it has been drubbed by the US market, by the S&P 500, and it has also been drubbed by emerging markets. Perhaps more pertinently, let's compare it to the other asset classes which perhaps matter most. If we take a look now at how it's done compared to gold or to UK gilts, you can see it's not the only stock market in the world of which this is true, but it's lost a huge amount of value compared to gold since 1999. It's also failed to hold its value against inflation, at least in price terms. If you reinvest dividends, it's managed to do that, but in terms of the underlying value of the index, it has not managed to hold up against inflation. And perhaps most tellingly, it has been drubbed even by UK gilts, and perhaps most intriguingly, this is starting from a high point for the stock market. According to the Barclays Equity Gilt study that came out today, even if you go back 25 years, a period that includes all the great equity bull market of the 90s, gilts have beaten equities over all of that period. Now that suggests the bad news, that there is nothing that impressive about this benchmark, but the good news is, again, that there's nothing that impressive about this landmark that we've just reached. Earnings are double what they were back in 99. That means obviously that stocks are much cheaper than they were compared to bonds. Plainly, they are far cheaper. There's the dividend yield on stocks is now very attractive. There was nothing attractive about it at all back in late 99. Now, if we take a look at this next chart, which is produced for us by research affiliates, this takes a look at the Schroder PE, or the cyclically adjusted PE. This is where you take the price and compare it to the average of earnings over the previous 10 years. And those different bars show you the maximum and minimum and average levels for the Schroder PE over time. And you can see that in absolute terms, the UK is one of the cheapest markets out there. You can also see that it's actually trading slightly below its long-term average cyclically adjusted PE. Compare that to the US, which has a much higher PE and which is far above its average, and obviously the UK gives you much less cause for concern there. It still appears to be one of the more attractive markets out there. If you're more interested in technical trends in the direction of prices, the next chart, which is produced for me by IDO Search, is very interesting. They took a look over the last 30 years for periods of 5-year rallies that were most similar to the one we've just had. They found 6 matches. This is what happened in the 6 months after each of those most similar points to where we are now. And you can see, with the one exception of 2007, when we went into the great crash of 2008, the FTSE managed to carry on rising for 6 months after reaching roughly this point. There is simply no great reason for great concern over the FTSE at this point. It may be pricey, but it's not in a bubble. Now, am I suggesting, therefore, that it's a buy? Not necessarily. First of all, as I said, it's heavily weighted into energy companies and materials. They have their own macro issues at the moment. Also, there's the issue of the currency. The pound has lost a lot against the dollar in the last few months, but given the direction of US interest rates, it could lose a lot more. Meanwhile, against other currencies, the pound has actually strengthened very significantly. There has to be some currency risk there. So I still don't really buy that that UK equities are a truly compelling buy, but they're not a scary sell either. Ultimately, the bottom line, this landmark isn't such a big deal as it might first appear, but that is in fact quite good news.